Now, Nvidia's jumped to the $3 trillion market cap, coming ahead of its 10-for-1 stock split tomorrow. Our next guest points to Nvidia's high share price and volatility as an obstacle for some options traders. So how could the stock split change things, and how should options traders be preparing? Joining us to discuss, we have Matt Amberson. He is Option Research and Technology Services Principal, joining us here. Thank you so much for being here with us. So start with me about this stock split coming up. What should options folks be considering ahead of Friday as a potential trade off of that stock split?
Yeah, thanks a lot for having me. The stock split's going to make Nvidia a lot more reachable for a lot of these retail traders. Now, you rarely see a stock over 1,000 with a 50% implied volatility. So the prices of the options are extraordinarily high. So option traders are really looking forward to the split. We'll be able to trade it a lot easier without the $1,200 price tag, which is quite high for option trader, just the normal option trader out there.
Yeah, I was going to say, in terms of the retail investor out there, it's a little bit complicated given that high price that we're currently seeing right now. So what would your advice there be, just in terms of, is there an opportunity, a risk reward setup that would make sense at this point?
Yeah, so Nvidia, it's just a crazy stock, right? It's we haven't seen this since 2000, and there's a measurement called beta, and the beta of Nvidia is 1.7, meaning as the market goes up, it goes up a lot faster. When it goes down a lot faster. So option traders, I think, could profit from not being short, but being long spread. So you could do these way out of the money spreads in Nvidia, and it's a way to trade this stock, the options, a lot more manageably for retail traders. And Nvidia tends to, as you saw in the graphs before, move one way. We saw a large up move and a large down move, and if you get some of these out of the money spreads, you can profit from that. A good risk reward, as you say, and then you measure that for not paying too much, but you could get these out of the money spreads for not too much money, maybe like 4%. You would buy a call and then sell a call $5 higher. You could do the same for a put if you're bearish, and then if you're neutral, you could do both at the same time. So it does present some opportunities with the strikes relatively short together. You could get into some of these spreads with a relatively small initial investment.
I want to zoom out a little bit here on Nvidia, because I'm curious about to what extent options traders should try to play the macro data for a name like Nvidia. I think about the ISM yesterday, for example, driving the whole market higher, including Nvidia, through things though like index funds, ETFs. Does that still mean that a big macro news day is a good day to play your options on a name like Nvidia?
Well, as I said before, the beta is so high that you get a lot more leverage with Nvidia, because really any interest rate announcement really affects Nvidia with such a high PE, as we heard from the earlier guest. The earnings are so far out that any change in expected interest rates really affect the price. So you could get some very large moves, which is why I would talk about out of the money long spreads, especially before macro announcements. Like tomorrow, we have a few. We score those on my firm's platform, the macro events, on a scale of 1 to 4. And we have some big announcements tomorrow, and especially interest rates announcements. You could play Nvidia before those.
All right, Matt Amberson, Option Research and Technology Services Principal. Thanks so much for hopping on with us here this morning.
Thank you.